Geopolitical turmoil, a volatile oil price, sticky inflation and high interest rates, none of which are showing any signs of stabilizing soon. So, what does this mean for global bond markets? And how are investors traversing the choppy waters of fixed income investing? I'm Jeremy Maggs, and this is No Ordinary Wednesday, our in-depth look at what's driving markets, shaping the economy and changing the game. Two guests with me today. I'm joined by Annelise, Chief Investment Officer for Investec Bank Switzerland, who was recently recognized as one of Switzerland's 6 top wealth managers by the Spears ranking of high net worth and ultra high net worth individuals. And alongside her is Awongiwe Booi, fixed income analyst and junior portfolio manager at Investec Wealth and Investment South Africa. They are our resident experts who give us a quarterly update on everything you need to know about global bond markets. We are well into the second quarter of the year. So how has the market performed? Where are the opportunities and the value? And of course, an assessment of fixed income as an asset class. To both of you, a very warm welcome to No Ordinary Wednesday. So, Annelise, I think we should start this conversation with a look at the geopolitical turmoil that I don't need to tell you is having far-reaching effects. Of the many conflicts happening around the world, 2 are rattling global markets. One is the war in the Middle East, the other is the war in Ukraine. So let's set the scene if we can. What impact are these conflicts having on economies, financial markets and the oil prices? I know it's a big question, but let's start with that.
Yeah, unfortunately, markets aren't very sympathetic to wars. If it doesn't affect the economy, if it doesn't affect growth, then they actually don't worry too much. So what we see is on the outbreak of the war, the oil price spikes because people are worried that it's going to break the supply of oil, like we saw now in the Middle East, and then it calms down. We had a similar reaction to Ukraine. There was a big blow up in the oil price and in gas prices in Ukraine, and then it calmed down. So we have these wars in the background. The gold price tells us that they're very worried about it, but the oil price has been very calm. I think the oil price is probably a little bit influenced by the Americans stockpiling oil, the fact that the world growth is slow, so that's keeping the oil prices at bay at the moment. It's not to say that we won't have a geopolitical blowout and that won't scare the markets, but for the moment, the markets are going along quite well.
So how then has the bond market reacted? Just a few months ago, fears of a wider conflict in the Middle East rattling the market, pushing the US 10-year yield to a 16-year high of over 5%. As we know, the yield is a benchmark for asset prices globally. So what's your assessment there?
So at the moment, the oil price has quite a big impact on the bond yields. I've been watching that really closely. So there's 2 factors at the moment at play in the 10-year bond yield. So at the one hand, the market's not too worried about growth. While that's chugging along nicely, the bond market and the 10-year treasury market is focusing on the oil price. And because that has been coming down from that 5%, the bonds, and the oil price has come down quite drastically from over $100 now to about $80, the bond yields have moved down to 4.42%. So that's quite a big retracement, but it is moving in lockstep at the moment with oil. The minute we see some weakness in growth, then I think the attention of the bond markets will switch to growth rather than oil.
All right, Awongiwe, let me bring you into the conversation now. I don't need to say that locally, South Africa is a commodity-centric country, and the conflicts then and the impact of the oil price would obviously affect our markets. So what do things look like in that respect?
Thanks, Jeremy. So as you mentioned, the ZAR is a commodity currency, right? As you know, oil and oil products make up a majority of merchandise imports in South Africa. And in the last couple of months, we've seen both the gold price and the oil price rallying quite significantly, I think at highs of $95. And what that means is that higher oil prices result in the ZAR being relatively bullish. Now, we consider the oil price, not the oil price per se, to strengthen the rand, but more what the oil price indicates. And that indication could be the underlying growth of the global economy. Now, with the ZAR obviously having a relationship with the oil price, at a certain point it holds until, the price starts getting too high. Usually our sweet spot for that is when the oil price goes beyond $85. So usually the price performs well between 60 to 70. However, when the oil price becomes higher than 85, it starts having a negative effect on the currency. So when it has a negative effect on the currency, it starts affecting basically the imports in South Africa, which then has a ripple effect on inflation. As the expectation of inflation starts getting higher, and what does that mean for bonds? That means higher inflation, it means higher nominals, which has a negative effect on bond pricing. So if we continue to see oil prices, or rather geopolitical conflicts continue in the Middle East, we could continue seeing higher oil prices, which will have a negative effect on both currency and nominal bonds in the long term.
All right, I want to circle back then to the local bond market if we can. You've mentioned sticky inflation, stubbornly high interest rates, and we could have an entire podcast on structural issues. How then is the local bond market being impacted now and moving forward?
So first and foremost, the South African bond market always takes its cue from the US, specifically Fed policy and Fed data-centric information. But I think overall regarding, low growth, infrastructure impediments, Transnet and Eskom not performing, in the last couple of years, we've seen that largely been factored into the bond pricing. I think what is evident in the last, 3 to 6 months is, the election coming up. We've seen positivity regarding the election rally. The market's priced in the ANC securing between 45 to 48% of the national vote, which is good at a baseline level for the bonds. Secondly, we've also seen, improved load shedding numbers. We've seen Transnet coming out with better than expected import delays. So we've seen less delays on the port side. We've seen Eskom coming out with higher than expected EAF, or electricity availability factor numbers. So overall, we've actually seen on the long part of the curve that slightly coming in, which has been quite positive for the SA bond market, and we'll probably going forward continue to see that, which will be basically positive for the fixed income market.
Just before I return to Annelise, Awongiwe, we can't have this conversation without discussing government finance. No need to say that our fiscal position has been strained due to those low commodity prices that you mentioned earlier. You've spoken about energy insecurity and the logistical constraints mercifully making some kind of improvement, though, and high debt numbers. So how's the global market currently viewing South Africa right now? One would imagine with a degree of concern and wait and see, maybe?
Well, I think, Jeremy, if you think about what the global sentiment is, it was well evidenced in Feb when National Treasury came out with its midterm budget. We saw National Treasury really being proactive and stepping up in terms of trying to decrease that deficit quite significantly. How they've done that is through tapping and monetizing the Jafekra. And what's happened there is that 150 billion rand monetization has pretty much resulted in us forecasting a positive deficit. So currently, the jet to GDP on the deficit side is minus 4.9. We can forecast that to slightly going down to about negative 4.3, which will be great. In total, we'll probably see debt going down from about 500 odd billion to about 320 odd billion. So 194 billion rand decrease in debt over the next 3 years. We've seen the offshore guys really come back into the market, not only because of just the rally of election, but partly because, the future, regarding the deficit looks a lot more pleasing. In addition to that, the latest provisional numbers that came back from National Treasury looks as though we have a positive cash balance or cash reserves, about 23 billion, which is probably the best cash reserve numbers we've seen before 2008 or at 2008 levels. So, overall, I think we can see it from the foreigners coming back in that it's positive that, National Treasury is taking its step in improving both the deficit and improving, how it's looking at its SOEs and the performance of the SOEs.
We are going to continue this conversation in just a moment. I would like to remind you quickly that a new episode of No Ordinary Wednesday drops every fortnight. Please don't miss it. Subscribe to Investec Focus Radio SA wherever you get your podcasts. And if you like the channel, please take a moment to rate us. Annelise Piers, let's pick up the conversation now and discuss macroeconomics if we can, and look at some of the major markets. In April, US economic growth slowing sharply. In Europe, a recovery is on track. So what then are you expecting in the mid to long term? What are key economic indicators telling you?
I forgot to mention earlier when we were speaking that, we also, another geopolitical factor we have is the US election coming up in November.
Of course.
And that is going to have an impact on growth. You will have some uncertainty ahead of the election. What has kept the oil price, I believe, quite well contained was that Biden has built up oil surpluses in order to counter any geopolitical stress that might be a shock to the US economy. So on the one hand, you have the politicians that are hoping the US economy holds up, but on the other hand, you have some fiscal thrust that is falling away. First of all, in the Biden package that helped American growth very much in the last year. Growth surprised markedly on the upside in the US, but is expected to surprise on the downside for this year. So the fourth quarter last year, US growth was at 3.1%. The first quarter was still strong at 3%, but the forecast for the second quarter is running at 2%. Now, if we look at Europe, growth there has been quite weak. We've been looking at German growth at minus 0.3 last year, Eurozone at 0.4. Going further to Japan, the growth rate there was 1.9 last year. They were the stronger one because they have kept their monetary policy very loose in comparison to most of the other central banks, and Japan is expected to slow down. So you're starting to see the US will slow down and is following the countries that were in recession basically in the last year, which is Europe, China, rest of the world. They've led it out of recession. So I do think we will see some momentum declining still in the US economic growth. So I expect a bit of a rocky road ahead of the elections. Biden will do everything to try and stop that. And I think that is why they're stockpiling oil in case we might have an oil price shock from other geopolitical problems.
So, Annelise, what then does this mean for bond markets?
But the issue for the bond markets, it depends on how quickly the US slows, because the problem for the US at the moment is they have strong growth. Unemployment is really low. Inflation remains sticky, and that ultimately means that the bond markets are not comfortable to rally just yet. And then, as I say, you have the worry about the oil price that might spike up. As soon as we see some weaker numbers coming through in the US growth, and people start getting more comfortable that the unemployment numbers are starting to come down, then they will feel that there is a glide path towards lower interest rates. The issue is that the Fed has never cut interest rates with unemployment below 5%. We're sitting at 3.6% unemployment in the US, so the job market's still very hot. And we're sitting with inflation well above. It's inflation running at about 3.1%, and the Fed needs inflation below 2%. So that means that the bond market is positioned at the moment quite finely, as I said, looking at the oil price. The growth is still good, but as you see economic momentum slowing down, I do think you want to be in G10 government debt. Do you want to be in other bond markets, your more risky assets? High yield debt in the US is priced really tightly. They're at the bottom of their historical range of 3% above US treasuries. So I'll be very careful about going into US high yield. I'll be very careful about going into investment grade. That is trading quite tight as well. And what happens is if you were to have a sharp slowdown or a recession in the US, you can see the spreads blow out in the high yield market to 9%. That is the high end of the spreads on high yield from, as I say, the current 3%. So whatever you make in the bond, US government bond yields coming down, you will lose in the spread widening. And investment grade is sitting at 90 basis points above treasuries. So I do think that the corporate and high yield market is not going to compensate you for taking the risk from this point on. So I do feel that you should be in the safer assets, in your insurance assets, which is the developed market government debt.
And to what extent, Annelise, is Japan a factor? We know the country's made big investments in the US Treasury market, but the economy is improving. Could it pivot out of the US to domestic markets possibly?
I think this is a question we've been speaking about for many years, that because Japan is an aging population and you've had good yields coming out of the US relative to Japan, it was more attractive to invest in US treasuries. But I have to remind everybody that when we had quantitative easing, local banks in America, insurance companies and pension funds have been squeezed out of the treasury market. So yes, Japan might be a seller on the margin of treasuries, but they still have a very big savings pool. And that is what's going into US Treasury. So all in all, the fact that the dollar is a reserve currency backed up by the US Treasury market, I'm not too worried that the Japanese selling treasuries will have a big impact on that market. Particularly, I think we have seen some fiscal imprudence by the governments, US governments. They have been spending a lot. And I think whether Biden or Trump comes in next year, they're going to continue to spend on the fiscal side after the elections. This year, I think we're fine on the fiscal side because the Republicans are stopping the Democrats from spending. But once the election's over, I think they're going to open the taps, but they can only open the taps as far as they can service the interest bill on those treasuries. So long answer to a short question. I do not think the Japanese pulling out of the treasury market will have such a big impact because there are other investors that will take up the slack.
So, Awongiwe, back to you then. I'd like to turn to emerging markets. So the turmoil of global interest rates, as we've discussed earlier, has unsettled bond markets over the past few months. But in contrast to previous cycles of high interest rates, foreign investors have stayed the course in emerging markets. So why is that, and is there a move?
Well, I think that question almost depends on at what point do you look at, how much foreign investors have been looking at SA bonds. I think over a 4 or 5 year period between 2019 and 2023, we saw massive exodus from foreign investors. At its peak in 2019, foreign investors were holding about 38% in bonds. That massively dwindled to about 24, 25%, mainly driven by Fed policy rates and inflation essentially eroding carry for those bonds. However, in the last 3 to 6 months, we've started to see that slight, positivity in terms of, foreign guys coming back into the market. And there's a couple of reasons. I think the first is, the event risk that is the election has been largely priced out. We saw last year in November, December, a massive, about 30, 40 or 50 basis points worth of event risk or election risk being priced into those bonds. I think the market is now pretty much comfortable in terms of what is the best case or the best outcome would be for that election, i.e. ANC securing a 45 to 48% national vote, not doing any coalitions with any left-wing counterparts. That's the one. The second is, as I spoke to earlier on, load shedding has been a massive factor. We've seen growth improvements. We've seen, tax collections slightly improve on that side, which we've subsequently seen that being priced out in the bonds. If you even compare, our bonds versus EM peers, we've seen those spreads slightly compress a bit. And I think lastly, and most importantly, we mustn't forget that EMs actually started hiking before developed markets. So because they hiked as aggressively and before the US and before the ECB and the BOE, now they're at the position where they can start cutting. We've seen a few of the EMs start to cut. So that's obviously would be positive for the bond market. And then largely, I think also total return. At the end of the day, offshore guys are looking for total return that can beat inflation. And I think some of the bonds present great opportunity. We're seeing a lot of the bonds right now being priced relatively cheap. Some would say that, some of the risk is unjustified, but in so that's saying that bonds are still relatively cheap. And I think a lot of the foreign guys are seeing that. And I think that's why we're probably going to see more and more trickle as the months go by.
Annelise, let's circle back very quickly, if we can, to interest rates. You did mention the Fed remaining cautious with no clear indication on a cut, but the European Central Bank set to cut rates in June. What's your broad outlook then in the face of what is obviously a divergence here?
Yeah, I think just to add on to what Awongiwe was saying is that emerging markets went ahead of the Fed, tightened a lot. Europe tightened to the same extent because we had a huge shock because of the gas prices and the oil prices. So just to go back, European inflation was running at 8.9. However, European inflation's back on track below 2%. Unemployment very high in Europe, still running at 6.6%. So there's a lot of headway for Europe to cut rates. The economy is weak, and we expect the first European rate cut to come in June. Switzerland has already cut and is expected to have their second cut in September. Japan, I do not, they wanted to not hike interest rates because they wanted to keep inflation high in Japan. However, the inflation momentum in Japan is starting to fall off. So I don't think they can hike interest rates. They'll probably stand pat for a while. And the US, as I've said earlier, they need inflation to be closer to 2 and unemployment to be above 5 before we will see the Fed cut rates properly. We might see an election cut before November, but you will have to see numbers that are coming closer to the Fed targets of 2. And if your inflation momentum falls quickly and surprises us, the Fed might cut, but they will still be keeping a beady eye on those unemployment numbers.
So if that's the case then, Annelise, what impact on long bond yields and also on major currencies like the dollar or the euro?
The longer they keep the short rates higher, I think the bigger the damage to the underlying economy. Monetary policy really works with long and variable lags, and that is coming through. It is having an impact. Unemployment is a lagging indicator. So by the time the Fed cuts, the damage will be quite significant to the underlying economy. And that will help the long bond yields to rally. So the long bond yields will look forward and say, well, the rates are staying high too long. It is starting to have an impact on the economy. But therefore, I think the long bond yields will rally well ahead of the first rate cut. And then if we look at currencies, as soon as the rate cuts are being priced into the dollar, we will see dollar weakness. The one thing that will support the dollar is if we have a recession in the US. If we have a recession and not a soft landing, that will impact the whole world. I doubt if Europe, China, and the rest of the world can withstand a US recession. And in that case, we will see a strong dollar. The euro is the currency. Euro and the yens are two currencies that have weakened against the dollar in the last 10 years, the yen in particular. If we were to have a recession, for example, the yen should rally because that's a safe haven currency as well. The Swiss franc is a safe haven currency. The euro will weaken further, which ultimately is good for the European economy in the long run. Europe is an export economy and they like weaker currencies. So you will have a double whammy of rate cuts coming through for euro, and a weak currency will really set the stage for a nice European rebound next year. And as I say, the US will probably lag.
Awongiwe, let's bring the currency conversation then to emerging markets, including ours. What are you seeing?
So I think with emerging market currencies, they're quite heavily dependent on the external backdrop being, commodity prices, the outlook of China from a macro point of view, and of course, the US dollar. I think at the moment, as Annelise alluded to, we could potentially see cuts before the election in the US. And that's, of course, if we see, monetary easing on that side. When we get a cut, we could potentially see US weakening on the dollar, which could obviously potentially be better for both EM currencies and SA. Even though currently SA, in terms of its current fundamentals is technically weak, we think that, if we do get the backdrop on weak USD, that would be pretty much good for SA. SA tends to perform better than other EMs when the USD weakens. So at the moment, it currently all really depends on what the outlook on the US is. Potentially, if we do see that US dollar weakening, obviously that's positive for EM. However, we still continue to see, the strengthening of the dollar that will still result in EM weakening.
And finally, let's end the conversation with an outlook for fixed income markets over the next year. Annelise, to you first of all, what's your sense for the global market?
For fixed income, as I said before, I really like developed market safe assets. I do think they're going to do well. One of the reasons are that the insurance bucket of the fixed income market's been in a 3-year bear market. Been a very tough market for the last 3 years. It's the worst bear market in 150 years, and therefore I feel comfortable to put money there and to sit back and have some insurance in the portfolio, given that risk assets have rallied so long and so hard. And I do think that as the US economy slows, the bonds will do well. Europe, in any case, I think is going to do well because the rate cuts are coming through earlier there.
And Awongiwe, as far as emerging markets are concerned?
I think, with emerging markets, I'll specifically talk to SA here. I tend to bucket SA risk into 3 buckets according to the SA curve. So you've got, the short part, the belly and the long. And obviously those parts are moved by different reasons. So, if we look to see that there are potential cuts from the MPC this year. That's obviously will be beneficial for the bond market as a whole, mainly on the short and the belly and the long. I've, spoken earlier on, the fiscal deficit. If we are able to slightly improve that, take down that deficit number from negative 4.9 to the 4.3 level that National Treasury has stated, that will be good from a fiscal risk perspective. Foreign guys are likely to come back into the market because they'll want to take long duration because they have more comfort that they don't need to be paid more regarding the long end of the curve. And then lastly, the idiosyncratic things that are quite indicative to SA, the Eskom and Transnet, etc. We're seeing slight improvement. Obviously, those, two structural reforms are going to take, long term to fix. But in the short part, we're seeing slight improvements. We can see that largely being priced out in terms of country risk. So overall, I think we're seeing a lot of positivity there just on the curve. I think probably in the belly, from a risk-adjusted basis, you're getting compensated for taking risk, versus, after 12 where it's pretty flat on the curve where you're not really getting that much compensation for. And I think lastly, regarding credit, I didn't touch on it earlier, but I think I should touch on it now. SA credit has been at an all-time tight, just like in Europe. Guys are searching for yield, and that is pretty much compressing all the spreads regarding issuance from the corporate side and the banking side, and regarding subscription of the bonds. So we're probably going to see credit still tight, if not tighter, for the next year. And I think fixed income, from a total return perspective, whether they're cuts or not, I think you're still getting compensated for the sort of risk that you're taking. So we're still positive on that side.
Awongiwe, Booi, Annelise, Piers, thank you both for joining me on this edition of No Ordinary Wednesday. Please join us again in a fortnight as we continue to explore money trends shaping your world. If you haven't yet added us to your podcast feed, please search for Investec Focus Radio SA wherever you get your podcasts, and all you need to do is hit the subscribe button. Until next time, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.